Good morning, everybody, and thank you very much for joining us today for our second TT Live webinar on Autospreader. This is the second webinar in a series of 3. In the first webinar, we covered the fundamentals of Autospreader, and for those of you who missed the first one, you can find the recording on our website. In today's webinar, we're going to look at some use cases of Autospreader and walk through the maths behind the spread creation of a varied group of products. Please feel free to submit any questions during this session, and we will respond after the webinar is completed. We will also be recording this webinar, and the link will be sent out to everyone who's registered. Today's webinar is going to be led by Michael Riley, who is a training and user experience specialist at TT. Michael's been with TT for around 10 years, and prior to that was a user of the platform, so has a deep understanding of the workings of TT. With that, I'd like to now hand you over to Mike.
All right. Thank you, Emma, and thanks everyone for joining. As Emma suggested, and as you can see on the screen here, we'll be covering some use cases within Autospreader, and really this is the purpose of this is twofold. One is to show some examples, but really to kind of encourage you to think about how any idea that you might have had regarding putting a certain spread together, and then expressing that idea in the market. Hopefully this will kind of connect the dots. So, the idea that you have will be able to kind of resonate with some of these, and then we'll be able to get this up and loaded into Autospreader and then let you use it accordingly. So with that, as Emma said, previously we had a webinar that covered the basics of Autospreader. So real quick, we're gonna rehash these some of the major ideas here, but the overall purpose of this webinar is not so much to go through the basics. It's really just to present these ideas and go through. So again, just to recap, what was the purpose of spread trading, and why do we do this? So first is simple arbitrage. So the act of kind of simultaneously buying and selling the same product that's listed on multiple exchanges. And this is, to take advantage of, a dislocation in a particular market. So let's say an oil contract is listed in 2 places, the same specs, contract size, delivery point, etc. You can use Autospreader to be present in both of those markets and take advantage of those discrepancies. Another common one is going to be correlated trades. So traders are going to look to hedge their trade by trading in the opposite direction of an instrument which happens to be correlated, and try and look for mean reversion, and sometimes the opposite. Sometimes they're looking for an expansion of the spread. So for example, if you imagine 2 oil contracts that are slightly different underlying products, and they may correlate, and then for certain geopolitical reasons, they may deviate. So also, we mentioned in the previous session, rolling a position. So as a future news expiration date, you might want to move your position from one to the next. In this case, you're selling the, probably the front month where you have a position, and you're going to be looking to buy the next month. So in order to do this, you can use Autospreader. And although an exchange might offer an exchange listed spread, a calendar spread, for example, Autospreader can be used to, allow you to possibly get a better fill, and again, benefit from that better fill. Also, market making, you can create a bid ask, product based on other related products. So if you could use a couple of contracts in crude oil, let's say the April and December, in order to speculate or provide a quote in June and September based on where all these various prices are. Okay, so again, we're not going to be going into setting up all the details of the spread, but we did touch on this last time. So what are the basic Autospreader configurations? The ratio is a big one. It's going to indicate how much of each leg we're going to be buying and selling. So we're going to be, buying 1 of this, selling 2 of that, or vice versa. Next is going to be the multiplier. We'll certainly get into both ratio and multiplier during this, but it's just good to touch on here. So the multiplier is going to be how we are going to adjust the price of 1 or more of the legs. Pay upticks is going to, as it states here, we're going to add the acceptable amount of slippage for a hedge leg. active quoting is going to determine whether we are going to quote on that particular leg. And then override tick size is just how we adjust the decimal and the pricing of the spread that we're going to be creating. As we go through here, we're going to touch on these 6 spreads. Some of them are open, some of them are not, but nevertheless, it is good to see the configuration. So as we move forward here, first one we're going to look at is going to be a spread between Brent crude, which traded on ICE, and crude oil that's traded on INE. And we, in this particular situation, what we're really trying to demonstrate is how we're able to trade these in a like-for-like manner. So in this case, we have Brent crude. We look at the contract size here. In this case, they're both 1,000 barrels. So that helps us. It's a bit more of a similar contract in that regard. But then the price quotation is going to be dollars per barrel versus WOM per barrel. Now, in order to get like for like, these do not quote in a similar fashion. So what we have to do in this case is add a third contract, the UC contract from SGX. And this will allow us to get account for the currency difference in how these two are quoting in a different currency. All right. So if we go over to our workspace, we can go to our auto spreader. Now we've built these out ahead of time to save us some time. But if we go to this particular spread, in this case, we have the crude ARB between ICE, INE, and SGX. And if we pull up our config, here we go, we'll see a few things. So first off is going to be the 3 legs that we have here. So the first leg is going to be the Brent. The second leg is going to be SC from INE. And the third leg is going to be the UC contract from SGX. Now, once we have our legs loaded, we do have a difference here from what the new spreads would default to. So generally they default to price differential. However, in this case, we're using a custom equation, and it is, the math behind this is going to be the first leg minus the second leg. However, we modify this equation by dividing the INE crude by the UC contract. All right, so this gives us, that contract in dollar terms. Okay, so in this case, we add the parentheses here, the beginning at the end, and we divide those particular contracts. Okay, so because it's 1,000 barrels on each contract, we leave our ratio as +1 - 1. We leave our multiplier the same. And then for active quoting, we could quote on both Brent and SC. However, we want to make sure that we are not quoting on the UC contract, because we're literally just using this for the pricing mechanism so that our prices are taking into account the currency difference. Okay. Finally, down at the bottom here, we do override the tick size. And this is just because, if there's too many decimals, in the equation, the ladder will automatically build out all of those decimals. That's not necessarily relevant for this particular trade. So we want to, reduce it a little bit here. So we use the override tick size and set it to 1/100. Now, when we go ahead and launch this particular spread, we can see our 3 MD traders here. So we have, the MD trader on the left for our auto spreader. Then we have Brent, SC, and UC. And as we place a trade, we only had Brent set as active quoting. That order will continue to quote based on our SC and UC equation that we've built into this particular spread. Another spread that's very similar as far as having to account for a particular currency is going to be the cocoa spread. Now, given the time of day, cocoa is not actually open. However, we can still look at this as it is a very similar and slightly different at the same time, slightly different spread. So In this case, there's a very similar layout here. So we have cocoa in the US versus cocoa in London. Again, same setup as the last time as far as the contract being the exact same size, so 10 tons and 10 tons. Price equation over here, we'll notice, dollars per metric ton, and then we have pounds per metric ton. So this is the same, currency difference that we had, or the same currency difference setup that we had in the last spread. So again, in this case, we will add the British pound leg, and this allows us to, view that London cocoa in a dollar term. So let's move over and take a look at the config again. And we'll walk through this one here. Okay, so in the same way that we had the last spread, first up, as we go through and we would build out this config, is that we would be changing it from price differential to custom, and then we would add our 3 legs. So CC May 23, C May 23, and then again, leg 3, 6B, which is the British pound future from the CME. Now, there is a slight difference from what we did before, in that when we go to our custom formula here, it's all the same except for the last portion here, in which case we are multiplying the C May 23 versus the 6B March 23. Now, the reason why we're multiplying rather than dividing has to do with the underlying specs of the currency contract. So in this case, 6B represents the currency cross of GBP over USD. And then in the UC contract, it was the won over the dollar. Excuse me, it was the US dollar over the won. All right, so in this case, we're multiplying it by that currency. In the other case, because it's reversed, we are dividing. Now, as I mentioned, this one's currently closed, so we don't actually have bids and asks. But again, just as an example as to how we are able to include the currency leg in order to build out our spread. All right, so our next spread is going to be HOGO, trading, which is going to be heating oil and gas oil. This is a popular spread as 2 fuels, they're closely related in supply and demand. And, sometimes their prices are diverging and oftentimes converging. So this is quite a popular spread here. Just going through the specs at the top here, we have heating oil, contract size of 42,000 gallons, and then the price quotation is in dollars per gallon. Now, for gas oil, we are at, we're showing 100 metric tons, and it is quoting in dollars per metric ton. All right, so there's, everything needs to be, kind of reconfigured in a sense here. Okay, so the goal will be, we're going to be converting these into dollars per gallon in order to get these, to equate. So if we go down in the lower left here, we've got kind of the math behind the conversion. So, like we said, gas oil is in dollars per metric ton. So we have 1 metric ton, which is going to equal 7.45 barrels. And each barrel is going to have 42 gallons. All right. So when we multiply those, we're going to have 312.9 gallons, okay, per metric ton. So in order to get the quantity, in equivalents in gallons, line 4 here is going to be 100 metric tons. Well, it's going to be 100 times 312.9 gallons. So that's going to give us the 31,290 gallons. Okay. So that is the underlying contract size in gallons. Okay. So for heating oil, we're showing 42,000 gallons, and gas oil, we've calculated that is 31,290 gallons, which is approximately a 3-to-4 ratio. Therefore, our ratio is 3 heating oil contracts to 4 gas oil contracts. Again, this is in order to get them to be like for like in the underlying deliverable product. So once we have our ratio, we still need our multiplier so that these, again, are looking, like for like. In this case, we go down to the lower left. Again, we have we need to get the gallons in terms, or the metric tons converted into a gallons multiplier. So in this case, we have 1 gallon, which is going to be equal to 1 divided by 312.9 tons, giving us our multiplier value. Okay. So in this case, we can go back to our workspace here. And as we take a look at the config, we'll see when we would build this config out, title, we would leave this as price differential because we don't need to customize the specific formula itself. And then we have HO and G for our 2 legs. And again, as we said, ratio is going to be 3 to 4. The multiplier on heating oil does not change because we didn't have to modify that, still representing the 42,000 gallons. And the multiplier on gas oil is going to be negative 0.00319959, just as we had calculated on our slide here. In the same way also as the previous spreads, we do use the tick override. Again, there's all kinds of decimals that are kind of being plugged into this formula. So in order to reduce some of that noise, we go ahead and 1 out of 1,000, 1 over 1,000, and then we can see fairly tight market. Go ahead and launch. HO market is a bit thin, so we're able to reduce the price increments. We'll say we'll want to see every 10. Then we can see that we are quoting in the spread at 189, and we are quoting in heating oil with a 3 lot and a 4 lot in gas oil per our ratio. Okay. Quick note, all of this, all the underlying information that we're relying on here to build out these spreads. We do have some, footnotes in the lower left corner of all these, but basically all of this information is coming from the exchange that actually hosts that product. So in this case, heating oil is coming from the CME. They would have a spec sheet on these particular products for every product, as far as I know. So we have the links in the lower left there, but a Google search would get you there as well. Both at the CME and ICE in this case. Also, I did want to note that in the ICE example here for this particular spread, the ICE does offer a exchange offered spread of the same product. In this case, you can pull it up here. Bear with me just a moment. And it seems a bit thin at the moment. Well, given that the spread is running a bit thin at this particular hour, the point was more to demonstrate that we are able to produce a tighter market using Autospreader and looking at the specific legs, which again, is one of the benefits of Autospreader. So by actually engaging in those specific legs of the spread, we are able to kind of tighten down the market and offer a better price that you can then achieve. All right, so next up is going to be a simple arbitrage between 2 S&P mini contracts. So this is a straight arbitrage between the CME and the B3 down in Brazil. So it allows you to take profit, or take the opportunity of any kind of pricing discrepancy between the 2 contracts. Both have the exact same underlying asset, which is the S&P 500 index. So again, straight arbitrage. And this is really to emphasize the point that Autospreader can be used to add liquidity to another market. In this case, with the exact same underlying contracts. contract size, price quotation, absolutely everything. So again, this particular market is closed. However, we can still take a look at the config, and it should be more similar to the configs from the previous webinar, frankly, as this is quite simple. It is still price differential. In this case, we have our two legs. One is going to be the ISP, which is the S&P down in Brazil. That's going to be our first leg, and then the ES at the CME is our second leg. In this case, we had set this up as active quoting only on the first leg, suggesting that that's slightly less liquid. And as far as the tick size override, no need to use it, as again, these two contracts are pretty much exactly the same, other than the location in which they are traded in. All right, so next up is going to be a treasury spread between the 5-year cash and the 5-year future. So just high level, treasury yields, because we're going to touch on the yield component here. Treasury yields are going to be represent the interest rate the U.S. government's paying to borrow money. Those are oftentimes the benchmark for other interest rate products, throughout the market, mortgage rates, for example. So oftentimes, there is a concern as to what is this future, or what are these treasuries, what's the yield on these treasuries, and then decisions can be made from that direction. So what we're going to do is we're going to not only build out the spread, but we're also going to show how we pull in the yield so that you can actually see the yield on the ladder and then trade that particular product and trade the particular spread based on those yields. So when we go back to the workspace here, we have, when we go to widgets and we go to automation, the last widget that we have here is going to be yield, and that's going to bring up a window that looks like this, somewhat similar to our Autospreader list. Now, from here, we can build out the specific underlying details for a particular treasury or interest rate product, really. So when we click create, we get our yield window. And from here, we need to determine, what is the, what are the details that we want to input and then calculate our interest rate based on. So if we go to contract, we're going to go to Explore, CME, Future, ZF for 5-year, select the March contract, and then we would go through and we would populate with, populate all the various fields based on what the exchange is providing. Now, as you probably noticed, there are quite a few fields here, and these values can all come from, or they do come from, the exchange itself. So in this case, we do have, here we go. The website in this case is going to be, from the CME group, tools information, quick strike, treasury analytics. Again, Google search should get you there. And then for the deliverables, in this case, we have a 5-year. There we go. When we select the 5-year, then we get this breakdown of the cheapest to deliver. So cheapest to deliver is going to be, a specific bond that is issued and it exists in the current window that the exchange defines. So they define that window, and then in this case, the information populates for you, and then this is what is used in order to input the values into the yield window here in TT. So once the information has been populated, you save the config, and then it exists in your list here in the yield widget. Okay, so if we go to our Autospreader now, and we pull up that config, we can see a few, we'll walk through the whole thing. So we named the spread. In this case, we'll be leaving the type as price differential. And then here we have the 5-year, which is a cash treasury. This is from CME BrokerTech, bond, UBO5, and the 5-year instrument. And then ZF is going to be our futures contract. So just CME, future, ZF, and March 23. In this case, we go back to our slide here, we'll notice the contract value is 100,000 on each. So our ratio is going to be 1-to-1, and the price quotations are both in are like for like. So no need to modify the ratio or the multiplier in this case. And as we go down here, again, to point out the yield, this field here, third off the bottom, we hit the drop down, and then we will see all of the different yields that we have built out, and we can apply those to, in this case, bonds, not necessarily futures, specifically for bonds. So in this case, we've selected 5-year, and then for our second leg, which is the futures contract, we can click on that drop down. We can select ZFMAR, which is our yield config that we created for the future. And automatically, when we start to set those, a few things happen. One is our ladder on the right automatically converts to the interest rate. And let's see here, automatically converts to the interest rate and also inverts. So I'm going to go ahead and close this, and we will launch this particular spread. Get this on screen here. Okay. So now from here, again, Autospreader MD Trader ladder on the left, 5-year cash bond in the middle, and the 5-year treasury, five-year treasury future on the right. So in this case, our pricing ladder on the left is the interest rate differential between the cash bond and the future. So you'll notice a couple more, make this a little bigger. There's a couple more columns here. We have yield on both the bond and the future. And our pricing ladder is that difference. So from here, we can determine what is the interest rate that we need to buy or sell this spread at, and then we can place our orders accordingly. If the yield does not appear automatically, by the way, right-click on the pricing ladder of either leg will give you the option for yield and show yield. So the next spread that we're going to look at here is going to be the knob, or the 10s versus 30s. Now this is going to be, again, it's a treasury. They're both treasury contracts for U.S. treasuries. So in this case, contract value, 100,000 and 100,000. Price quotations are like for like. So in this case, it will be, a few things will need to change. But these values for this particular spread is directly from the exchange. And bear with me as I pull up the window here. And basically, from the exchange, they actually determine what are the norms for their leg quantity ratios. So in this case, we have all the various contracts running down the left side here. Again, this is from the exchange itself. And as we get down here, we see our ratio is going to be a 2-to-1 for the, here we go, is going to be a 2-to-1 for the knob spread. So now that we have our spread, we also note that we'll have to adjust the multiplier in this case, because the 10-year and the 30-year do not tick in the same fraction. So the 10-year is going to tick in 30 seconds, while the 30-year is going to tick in 30 seconds. The 10-year will tick in 60/4. So going back to our config here, we can go to the knob config. And as we pull this up, a few things to note. So first, we're going to be looking at this spread in net change in ticks. And then as we go through here, we'll be looking at first leg, ZN, March 23, second leg, ZB, March 23. And in this case, well, based on the document that we were just looking at from the exchange, the ratio that we're going to want to use is going to be a 2-to-1 ratio. And then again, based on the tick size, we are going to be using a multiplier of 1/2 and 1/2. And then on the override tick size in the lower right, we are going to be looking at 1/2, because if we were to leave it, for example, as 1 and 1, we're not getting the granularity on the 10-year contract if we go 1 by 1. So by using tick override, we can set it to 1 by 2, and you can see that we see a little bit more granularity in that liquidity by going the half ticks. Okay, so pull this spread up here. All right, so again, Autospreader on the left, 10-year in the middle, 30-year on the right. You will notice, as we were saying, the tick size here, we're going in 1, 2, 3, and 4, versus on the 10-year where we're going 14, 14.5, 15, 15.5, etc. So same way, in this case, we're quoting only on one leg, but as we place our orders, in they go, and they will continue to quote based on the leg that they are leaning on. All right, so just in summary, all of those spreads are kind of already set, and they already have their configs. However, anything that you really can think of, there should be a mathematical way to achieve that kind of spread and building that out within TT using the Autospreader tool. So if there's any questions on how to do that, certainly let us know. We do have a distro at training-ux@tradingtechnologies.com. So if there's anything that you need clarification on, we can certainly touch on that. Then we did want to mention as well, the Autospreader runs on a dedicated servers for this sort of thing, and the latency numbers that are shown can be shown and displayed in the audit trail within your workspace. So generally, Autospreader latencies for requotes is 175 microseconds, and the hedges are 225 microseconds. So TT Prime is a premium version of Autospreader, which allows it combines the spreading logic, direct exchange connectivity, and the market data, and the order routing. So it's a single streamlined process that significantly increases performance and reduces latency by more than 85%. Currently, this is available on CME, ICE, ICE-L, Eurex, and B3, and then we'll soon have this on JPX, SGX, MX, and LME. If you're interested, certainly reach out to us. We'll get you in touch with the salespeople that that can talk all the numbers and work out all the details with you. And again, any questions that you might come up with, whether it's spreads or TT Prime, whatever it might be, we're available at training-ux@tradingtechnologies.com. And yeah, let us know if there's any questions or concerns, and we'll get them sorted. All right. Thank you very much.
Thanks, Mike. That was great. Our hope is that this webinar has given you a good insight into the calculation that needs to be done before a spread can be created. Autospreader provides users with a great deal of flexibility and is an extremely powerful tool when it's used to its full potential. As Mike previously mentioned, feel free to send over any questions that you may have to training-ux@tradingtechnologies.com, and we'll come back to you with the answers. The last webinar in this series will cover the use of Autospreader with some of TT's other advanced tools, such as Aggregator, Algo Design Lab, and AutoTrader. Thank you very much for joining us today, and we look forward to seeing you on our next webinar. Goodbye, everybody.